Welcome to today's explainer. Honestly, stepping into the crypto market right now feels straight out of an epic high-stakes anime showdown. It's July 20th, 2026, and the entire ecosystem is caught in this massive clash of macroeconomic forces, shifting regulations, and some pretty wild on-chain data. We've got our heavyweights taking massive hits, resilient challengers powering up their tech, and huge legislative battles looming on the horizon. I'm absolutely pumped to guide you through this dynamic landscape today. Okay, let's dive into this. Think of this as our quest log mapping out today's market fronts. First, we're braving the global macro storm. Then we'll look at Bitcoin's bearish reality, followed by Ethereum and Cardano powering up. After that, we'll navigate the regulatory squeeze, and finally, we'll break down the SEC and Genius Act. So starting us off, Section 1, the global macro storm, which is creating a heavy risk-off environment. Right now, there is a heavy, risk-off storm raining down on global markets. We're seeing escalating U.S.-Iran conflicts and continuous strikes causing real disruptions in the Strait of Hormuz. That's driving up oil prices and, naturally, weighing heavily on risk assets across the board. So we have to ask the big question. Is the crypto market quietly powering up for a breakout here, or are we staring down a brutal, prolonged boss fight? Well, the data tells a striking story. I absolutely love this quote from Andy Liu, the head of HTX Research, because it perfectly sets our baseline. He says, in Q3, BTC's direction depends on liquidity, and ETH's direction depends on regulation. This is fascinating, right? Because it means Bitcoin isn't just acting as a native digital asset anymore. It's currently behaving like a massive proxy variable for global US dollar liquidity. Literally, if liquidity dries up, Bitcoin takes the hit. Which brings us to Section 2, Bitcoin's bearish reality. The heavyweight stumbles. Look, Bitcoin is currently trading near $64,000. And yes, it rebounded slightly after testing a 21-month low in late June. But underneath the surface, this heavyweight is taking some serious hits. We're tracking three major bearish strikes on the front lines right now. A severe stablecoin liquidity drain, serious U.S. institutional apathy, with the Coinbase Premium index sitting negative since May, and record buyer capitulation. The buy-side armor is fiercely fading here. And this brilliantly illustrates exactly what I mean. Over the last 30 days, roughly $2.3 billion in stablecoins have exited Binance and Bybit. You can think of stablecoins as the dry powder of the crypto battlefield. When they leave the exchanges, the actual resources needed to durably break out of a consolidation zone simply vanish. Then there's this staggering number, negative $90 million. Recent buyers who entered the market at much higher price points, some as high as $126,000, are capitulating. They're realizing record monthly losses averaging near $90 million. In market psychology, seeing buyers aggressively sell at a massive loss like that, it often flashes a vibrant red warning for deeper corrections. But here's where the plot thickens. Even the ultimate Bitcoin bull is playing a defensive stance right now. MicroStrategy recently sold $263.5 million in MSTR shares to boost its US dollar cash reserve to over $3.2 billion. And how much Bitcoin did they buy during this period? Zero. Absolutely none. When the biggest institutional whale hoards cash instead of buying the dip, it removes immense buying pressure from the board. Let's shift gears to Section 3, Ethereum and Cardano power up, the resilient fighters in this arena. Let's move to and see how this builds, because the altcoin protagonists are actually writing a very different story right now. While Bitcoin is fighting those massive headwinds of liquidity drains and institutional apathy, Ethereum and Cardano are successfully powering up. They're experiencing active whale accumulation and executing historic community-driven upgrades. Now, what's really interesting about this slide is this specific metric, 10,000 ETH. A newly created whale wallet just withdrew roughly $18.6 million worth of Ethereum right off Binance and immediately staked it all. This move dropped the staking exit queue down to zero. It dramatically tightens the liquid supply and signals intense long-term confidence from some very big players. Meanwhile, over in the Cardano ecosystem, they just successfully activated the Van Rossum hard fork, Protocol version 11. This is huge. It's the first major upgrade fully approved on-chain by the community via the Voltaire governance system, and it brings much faster, cheaper smart contracts. Also, isolated alpha projects like Cashcat and Bank are seeing some massive daily pumps, proving that specific narratives can still defy the broader market's gravity. Next up, Section 4, the regulatory squeeze, the changing rules of engagement. Over in Europe, the operational rules of engagement are changing dramatically. The transitional grace period for MiCA, that's the Markets in Crypto Assets Regulation, has slammed shut permanently. Today, only fully authorized crypto asset service providers can legally serve EU clients. It is an absolute survival of the fittest scenario now, where unauthorized providers are officially and legally cut off. And you can see how this plays out. The race to secure these regulatory passports has clustered heavily into specific regions. Germany is leading the charge with 55 authorized CASPs, followed by the Netherlands, France, Malta, and Cyprus. These jurisdictions have essentially become the new fortified strongholds for compliant crypto businesses operating in Europe. But regulations are evolving stateside too. SEC Chairman Paul Atkins recently proposed a sweeping 2026 agenda that would allow a single license to trade both Bitcoin and traditional stocks in the exact same account. Think about that for a second. This is a historic opening that could allow platforms like Robinhood and Coinbase to integrate services and create incredibly powerful all-in-one accounts. Finally, Section 5, the SEC and Genius Act. Welcome to the legislative battlefield. While that SE vision offers incredible hope for the industry, a formidable new threat is simultaneously emerging. Coinbase is currently facing a massive danger to its $305 million in stablecoin revenue, all due to proposed OCC rules under the new Genius Act. This legislation might actually prohibit loyalty reward payments on USDC, which threatens to shred a major revenue stream. So, what does this all mean? Well, this immense regulatory density is forcing a true survival of the fittest scenario across the globe. The platforms that can secure proper authorizations in Europe and integrate traditional stocks in the US stand to gain an unstoppable edge. Meanwhile, those caught out of compliance, they face business-ending enforcement and severe revenue cuts. Which leaves us with this final thought. We've watched heavyweights bleed liquidity. We've seen resilient altcoins power up their tech, and regulators are drastically reshaping the battlefield, from European authorizations to sweeping SEC mandates in the US. As these geopolitical macro storms and legislative forces collide, which players will successfully navigate this environment to claim ultimate victory? It's a thrilling question, and I can't wait to explore how this clash resolves with you next time. Thanks so much for joining me on this explainer.